Hello, and thank you for joining today's Family Office Network's webinar series. I would like to welcome Scott Travasos. Scott founded the Swell family of business in 2006 with his college teammate and partner, Eric Gilmer. Scott has over 20 years of development experience, including homes, commercial buildings, and even stadiums. Scott has an MBA from Wake Forest University. Alongside his real estate experience, was an award-winning CFO from his time with Blue Shield. The Swell Fund is part of the FON network and is currently raising $1 million. At the end of today's presentation, we will have time for Q&A. We encourage your questions, so please use your questions chat option on the right side of your screen to submit your questions over. With that said, let's get started. Scott, I will let you take it from here.
Thanks a lot, Lindsay. Thanks so much to everyone joining. Thanks to the Family Office Network. We are the Swell Fund, and today we're going to talk about real estate investing in today's market. We're going to talk about what are the new trends and how family offices can invest in a profitable niche of the market with limited risk. We're not going to go too long. I've been on plenty of webinars in my life. We'll probably wrap up in the next half hour. And then what I really like at the end is opening up for questions. A little about the Swell Fund. We're currently raising $100 million. I think we might add a typo in the bio that said $1 million, but $100 million. And we've been working on this since 2006. What we really pride ourselves on is the ability to source undervalued assets and bring kind of high-level award-winning designs to assets in unique locations. This is myself and my partner. We played college soccer back together in the mid-90s and have been doing a lot of work together ever since. These are a few others of my team. I would just briefly point out the Browns. Lindsay and Rory are amazing architects and interior designers and really give our products an edge. Throughout the presentation, you'll see a number of photos like the photos at the bottom that are primarily done by them. A couple projects we just had sold. We are in northern San Diego and Encinitas, work in Encinitas and La Jolla and Carlsbad, a few other places. But enough about us for now. You came here to learn about the trends in real estate, so let's talk about those. After attending this webinar, I hope you'll be able to understand some trends in the overall real estate market, why high net worth families are moving and where are they moving to, why investing in a niche market minimizes risk, understanding nuances in location, how modular construction is changing the industry, post-pandemic long-term success strategies, and how to invest in live, work, play areas. And I'm going to try my hardest not to read every slide, even though I read that one verbatim. Okay, so previous landscape, what have we seen in real estate, especially we'll call it pre-pandemic? We saw most family offices, and I should interject here that I've worked for foundations in the past. Our two largest investors are family offices. So, this is a space I'm very comfortable in. I grew up in Boca Raton, Florida, around a number of family offices, and I've lived in the West Coast. So this is somewhere where I consider myself understanding and hopefully get to meet a lot of you. But the previous landscape was mostly, I think, by commercial. A number of family offices invest in REITs. Most of these networks had narrow focus, and what I mean by that is they were focused on just industrial, a REIT or a real estate investment group or high-rise urban or retail. They had some different things, and we think that was prior. Right now, we don't see a lot of narrow specialties as recommendations. We'll get into later in the slides about diversification. We do think if you know someone that's investing in data centers, that's a great investment. But a lot of these previous investments, we think things have changed. What is out? Commodity space. Spaces where one looks like another, and this is out in residential, commercial, and hospitality. As far as in regard to residential, boring homes are out and small lots are out for obvious reasons within the pandemic. And we formed this through our own opinions and our own certain things, but the media has been all over some of these trends. Luxury home markets increases, luxury home sales highlight growing U.S. wealth gap, LA Times, I'll come back to that in a second. California resort towns see growth, The office work from home is here to stay. Time for change always presents significant opportunities. Real estate presents a lot of opportunity as pandemic hurts assets in CNBC. Residential and land, we'll talk about this later, new US News. Housing market will stay strong in 2021. REITs are recovering, but some are on shaky ground. And how the pandemic is shaping the importance of home design, which I'll talk to. But going back to that LA Times quote, really what we see is the major trend right now and is just the wealth gap that's occurring. My guess is that somewhere between 90% and 100% of people on this call saw their net assets for their family office increase in 2020. We also know it's an extremely hard time for a lot of Americans. And what we see that has been consistent, throughout the history of the world is over time the middle class erodes a little bit. America in the 70s, 80s, 90s, 2000s, the middle class really grew, but we're starting to see some erosion of that. And we're starting to see that people with money are getting more money and they're buying what they want. And whether a house costs 3.2 million or 3.4 million is irrelevant to them. If they've decided they want that house, they want that house. Whether a small office, what we like to call light commercial, whether it's $3 a square foot or $3.50 a square foot, doesn't matter if it's in the location and place they want. What is in real estate investing? Custom homes are in, amazing homes are in, marquee locations are in. People want unique, highly curated spaces in live, work, play locations. So what are some of these effects on real estate? In residential, what we're really seeing is a limited inventory in some of these live, work, play locations. People who already were there are not leaving, and as people want to come in, there's increased demand, and there's just not the inventory at this time. And if you really think about it, and we'll talk about a few of the places, specific places later, but we're not talking about massive migrations. But if 100 people want to move into an area of the country, high net worth individuals, that's a huge change. Even in some places, 10 people moving in. If the houses and real estate is not available to them, it's a significant change. Also, what we're seeing in residential is for a lot of people that are moving to these new locations, it's frankly cheaper. It's cheaper to move to where they want to be than being in New York or San Francisco. Commercial is where I want to spend the most time on this slide. What we're seeing is a significantly increased demand in 1 to 8 person offices. What we're seeing is people want to move into new towns, to new locations. They're buying their primary residence and they want an office. They want an office for 1 to 8 people. Most of the time it's 1 to 4, but we've seen upwards of 8. They want their own private space. They do not want to be in a co-work space. They do not want to share a deck. They do not want to be in a mid-rise with shared elevators and shared hallways and shared bathrooms. They want their private space with their own office, their own bathroom, sometimes even a shower. And they want walkability. This has become extremely important in the pandemic. Walk into the coffee shop, walking to the local restaurant, being able to meet with friends, and also near beach and mountain access, which we'll talk about throughout here. Additionally, what we've seen due to some high net worth migration and hospitality, we've seen a change there too. Out are the Hiltons and Marriotts, and not those brands specifically. You could throw Hyatt and Westin and everything in there, but people don't want to go in a common hotel and a common pool and a common gym and a floor and common restaurants. They want boutique, highly curated spaces. They want some room. They ideally want their own door entrance from the exterior. They want it to be private, and they want long-term stay options. Also in hospitality, we're seeing the rise of high-end luxury Airbnb places. We have 2 homes right now we're renting for $25,000 a month and $30,000 a month, specifically from people from LA who want to get out of this city, who are coming down to our neck of the woods. So why are high net worths moving from urban locations? I think most of you know this. I won't spend too much time on the top part, but 50-hour work weeks are simply just no longer required in corporate headquarters. And I used to work in downtown San Francisco. We had an office in downtown New York. All of the people I used to work with are not working in the office full time anymore, and we don't see that changing anytime soon. We do think from a real estate perspective that a couple of years from now, after the pandemic, hopefully is under control and in our rearview mirror, we think People in their mid-20s, early 30s that are climbing up the proverbial corporate ladder will still work those long hours in offices, but the people with money, the CEOs, the COOs, whether they're of Google and Twitter or whether they're just of a private company, are not putting the long hours in the office. Family, health, and lifestyle have now become more first priorities. We've also seen a lot of people now are working, 5-6 hours a day, 7 days a week. We see a big change. We actually see more weekend work going on, but we see more people playing golf at 9 a.m. or going for a hike with their family at 2 p.m. or what have you during the Monday to Friday. We see a change kind of work, a little more consistent with what's happened in Europe over the past. High net worth desire, when they're looking for homes, what we see is they're really looking for dedicated offices. I have a friend who works for a large REIT, built himself a $5 million house and didn't put in a home office. And he's scrambling during the pandemic. When he has to work from home, he has to work from his bedroom or he has to work from his kitchen table with the dog and the people with kids running around. And he wants his home office. We're seeing ADUs are highly desirable. If you don't, ADU is an accessory dwelling unit. It's mostly 1,200 square feet, give or take, detached from the house. And people want those for some want them for their office, some want for a weight room, some want for their kids' school to go in there, some want their in-laws. But ADUs are extremely in high demand right now, as well as this pool or recreation on privacy in a yard for entertaining. People want their space. They want to be able to not have their neighbors on top of them. We're not big on condos right now, even luxury condos. Most houses we see going for sale in the Western US, people want a minimum of a 1/4 acre, ideally a 1/2 acre from the high net worth perspective. And they want a location near the beach or mountains. Maybe a lake could go in here too, a river, but they want somewhere where they can work and they can play and they can be with friends and family, close friends and close families. And we're seeing them move to live, what we're calling live, work, play locations. You'll see that throughout the slide presentation. San Diego, Tahoe, Vail, the Hamptons, Cape Cod, Charleston. There are a number of places, other places in there as well. And there certainly are some micro locations around lakes and rivers in Indiana and different places like that. But we're seeing a significant amount of people moving from Chicago, New York, San Francisco, and some of the other large cities to these live, work, play locations. So with that said, how is it best to invest in these live, work, play locations? Up in the upper left, we have the phrase location, location, location. And this is probably the most overused phrase in real estate, but we like to put an extra couple layers on it. And we'll say location, 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 within location, 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 within location, 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 meaning too many people just say, oh, this is a great city. Let me buy an asset in this city. Let me buy a piece of commercial real estate. Let me buy a boutique hotel. Let me buy a residence in this city. We think after you identify the city, you then identify streets or areas within the city that are unique. And then once you do that, you identify properties on those streets that meet some of these other needs in the bottom right. Do they have land? Do they have room around them? We look at rehab projects, meaning some work still needs to be done on the house. We don't believe in investing in houses that are already dialed, so to speak. Entitling projects. Do any of these, can they be subdivided? Can they be rearranged differently? Light commercial in these spaces, again, we think this is a booming space right now, and high design. We recommend that you invest with proven operators and fully integrated firms, which I'll touch on the next slide. But you need the location in the upper left, and you need at least 2 of the circles in the bottom right to have a successful project. You cannot say I like the Hamptons and I'm going to buy a place in the Hamptons. There's too many other factors that go into it. So why investing in a fully integrated development company? So I'm going to talk a little about our organization, but there are other organizations like this out here, and this is what we see the future really of real estate development. To ensure profit and risk, you have to have ownership of most or all facets of the cycle. For example, at Swell Fund, we have the whole cycle. We have the developer, which is us, and then title, we develop and entitle. We have the purchase agency. We have a Swell real estate brokerage agency that does the purchase and the sales. We have the architect, which is the Brown Studio. We have the design team, which is called SOTA, state of the art. My partner is from Minnesota, so a little play on words there. And we have two construction entities, the Foundry, which we'll talk about later, which is modular construction, and Brown Bag Builders, which is more traditional construction. And quickly, why do our projects have increased IRR and other integrated developers have higher IRRs? Well, there's a time savings and improved project integration, a build design approach when you're doing the architecture, ability to quickly pivot when necessary, including pivot to renting, ability to buy and sell off market, and ability to discount services on the bundle. And just let me talk a little about just dollars and cents here. If you don't own your own real estate brokerage, you're paying on every transaction, purchase and sales, somewhere between 6 and 12% roughly, or we could say 5 and 10%. That's obviously a significant dollar amount. But when you go to the builder, the design team, and the architect, and each of those, if you're going to the best-in-class firms in your area, if your developer is hiring a local architect and is hiring a local builder and is hiring a local designer, all those firms are putting, let's call it 20% profit margin on their work. You can see how the costs add up. What we're able to do and what other integrated developers are able to do is you're really able to discount within the suite. For the most part, on most projects, we do our construction and our architecture and our design at cost, and then we let the profits roll into the project and share overall when we go into there. So we think this is extremely important. We think a number of developers aren't doing this, and as the cost of construction and the cost of design are rising and the cost of land is rising, we think this is a crucial element. I'm not going to talk much about this slide. I just put it in. You could look at it later. Here's kind of how we see part of the development from program analysis all the way to construction and opening. And when you have that all in-house, you can start to understand some of the integration advantages. Modular. I touched on this earlier. We'd like to just take a minute or two to talk about modular construction. There still, of course, will always be traditional construction, but modular construction is here to stay. A lot of people think modular construction, they get confused. They think it's mobile home construction. They think you're constructing mobile homes, which is certainly not the case. These are prefab units. They're engineered to the highest standards. In the bottom right, some of the advantages of going modular are a faster, more efficient construction process, an indoor controlled construction. I'm going to show you our Tahoe project in a second. I'm going to show you a short video on it, but for the majority of it, all winter long, we're building indoors when you can't be building on the mountain. And you can imagine the time savings and cost saving that brings. The ability to serve remote locations, low construction waste. Waste is eliminated dramatically, environmentally friendly, flexible, higher quality, and easily repeatable. So the Palisades, this is our project up in Lake Tahoe, and back to location. It's not just in Lake Tahoe, it's on the base of Squaw, which is where the Winter Olympics were. It has a free shuttle to your front door. These houses are going for $2 to $3 million for people that are moving out of the Bay Area, moving out of San Francisco, but want to stay in the Bay Area. And I'm gonna click this video, which I think is gonna work in here. It's only 1 minute, so if we have any problems, there we go. So this is our project in Tahoe. This is obviously during the summer. So the houses are built at a factory site, industrial site, and then they're brought in and they're installed in the field. So the garage you can see is wood that was installed in the field, and the joints, there are some field instruction, but here comes part of someone's home, and it just gets craned in, and you can imagine the time and efficiency savings when you're building high-end homes. This process saves roughly $300 a square foot on construction costs for this particular project, which is astronomical. You can see the kitchen is already built in. The kitchen is built in the factory, and gets shipped to the factory like this, and then gets joined up in the field. And it's really a superior product from what is otherwise offered. I think that's it on. Yeah, so that's it on modular construction. Just wanted to introduce everyone to that. And as we get into the Q&A period after, I'm happy to dive into more details, or if you'd like to reach out individually, I'll have my contact information at the end. We could really talk a lot more about modular construction. But you can see this is, I'm pointing at this screen like we're in person. 63 units, you know, this is kind of the perfect, you know, when you're building a neighborhood that's somewhere between 18 and 80 units, modular construction really has quite a few advantages. So as we're talking through, you know, we're kind of wrapping up a little bit here, and then we'll dive into a few more details. But what are some of the recommendations for your family office's real estate investment strategy? We think it's very important to have right now in this time in history to have a blend of short-term projects and long-term holds. And that not only means what you're going in expecting it to be, but that you're also recognizing that things might change within stream. Hedge against market corrections, seek properties that can be rented, and lengthen your investment horizon. I'd like you to tell you a story. The middle picture on the right, those kind of long houses, we did a project right across the street from there. This is, by the way, this is 200 yards from the sand in Encinitas, California. We did a project and started in late 2006, a very similar project, and just got waylaid by the 2008 crisis. All the worst things that could happen to a project could possibly happen. And a project that was supposed to be done in early 2009 wound up finishing in 2016. But because of a couple things, because our investor had a long-term horizon, because it was a property that can be rented, and because we could wait for market correction, probably our worst project of all time wound up still making the investor $1 million. It wasn't a super high IRR, but we were able to rent it before construction when we were developing the plans. After construction, we were able to rent it out, and we were able to wait out the market cycle. And we were able, now who lives in it is an X Games gold medalist and a local famous athlete. Two very high profile people. Project looks great. It was a success, but I know working with family offices, as much as everyone wants a great IRR, equally so you don't want to lose principal. And one of the reasons we think you should, if you invest with the right teams in the right markets, with the right strategies, it really protects your downside while also giving tremendous upside. Going back to the list, we think opportunistic positioning via asset type and location. We've talked a little about that. Low risk projects with upside, I just mentioned. Highly curated design. We have yet to see even things that we don't build. We've yet to see anything in the Western US markets that we're in that's been high design that hasn't sold before the ones that don't have the high design. And the cost of that extra design might be an extra $50,000 to $100,000, but it comes back in spades. We think right now recommendations is be careful about urban commercial. A lot of things I'm seeing in some of the urban markets and talking to people, there's definitely some concern there. We think avoid middle-class housing, massive building projects for the masses, you know, 200 unit projects from Shea Homes or Lennar. Nothing against those specific companies, but just in general, we're very reticent about right now. We think you need to diversify your real estate partner mix. We recommend if you're only with one or two partners, that should not be the case. One thing we pride ourselves in is we don't want to be anyone's sole partner. It's just part of our DNA. We think that when you're working with family offices that you should have at least 3 to 5 development partners that you work with, again, just to mitigate that risk a little bit and diversify your asset class. We all know about diversification. You're all experts in diversification. Your stocks are totally diversified. Just make sure your real estate's diversified too. And that we think you should really focus on A+ locations. When you do that, in our little down in the lower left, we have never lost $1 of our investors' principal. most of the time we're making, in our slide deck, we say 14 to 28% returns, and that's pretty consistent. We hit some home runs, but we're probably more proud of we've never lost a dollar of principal. And we think if you have the right firms and the right diversification, that can be yours too. Asset allocation, we've touched on this. I won't spend too long on this side. Hospitality, we really like boutique right now. Residential, we like high-end homes, and we're saying that's the particularly not the ultra high end. That there's a lot of risk in the Palm Beach homes on the water, or Mar-a-Lago, and different things that are getting a lot of attention in the news right now. But we really like the $3 to $7 million range right now, where people with significant money can buy houses that aren't outlandish, and they can resell them if something changes in their family. Commercial, we think light commercial in live, work, play locations is perhaps the best investment right now. And then some other strategic opportunities we look at. Almost at the end here, what should your family office do next? Quadruple down on location, location, location. We can't emphasize that enough. The right submarkets within the submarkets. We think invest with the integrated development partners, which we spend some time on. We think diversifying your mix of real estate assets, invest in award-winning design, and invest in live, work, play locations. And most of all, of course, contact the Swell Fund. Kidding aside, here's our information. Our website's kind of under development, but we have a deck we're happy to share. Here's my email and my phone number, but we are really excited for what lies ahead. We think the market is still gonna continue, at least for the next 18 months, continually going up pretty quick in the high net worth areas, and we're poised for playing that, and we hope you are too. But we're also confident in the areas we're investing in, and we hope you're investing in, that if you have the right long-term strategy, you have the ability to hold an asset, that you will protect your asset class, and you will see upside as the market continues to evolve and grow as we come out of this post-pandemic cycle. So that's our presentation. What I'm hoping, it looks like we have 53 people or so on. I'm hoping we have time to dive into some questions and get in some details.
Hey, Scott, thank you so much. Great job. I appreciate that. And yes, to all of our attendees, jumping into Q&A, again, using your questions chat option on the right side of your screen to submit any questions on over. Let's see, Scott, I'm just going to dive right in here. First question, how would you define undeliverable assets?
Sorry, what kind of assets? I couldn't hear you.
Undervalued assets.
Oh, yeah. So I think right now, what's most dangerous are real estate developers that are buying assets that have already been built out. A lot of times they were late in the cycle, they didn't have the accommodations that are needed. So by undervalued, we're looking for assets that need either rehab, we're looking at land for one, we're looking at rehab for two, and we're looking at rezoning or re-entitling for three. We think this is really the opportunity to protect your downside and significantly increase your upside.
Perfect, thanks so much. Pablo would like to know, what's the entry point to invest in the Swell Fund?
250,000 is our entry point, and we go up from there. We're looking, what we're looking for really, we're capped out at 99 investors as we raise our 100 million, but we're really looking for 10 to 20 key partners that can help us. And we're not looking to raise $1 billion. We don't think there's $1 billion of inventory out there that we know of. We like our niche, and we're really comfortable in our niche.
Great, and actually that kind of jumps to the next question, Scott. Funny you say that. What would you do if you were offered $1 billion?
Yeah, we would say we won't take $1 billion. We think we could comfortably place about $100 million to $250 million and look at projects. And what we're cognizant of is getting over our skis. And I think the way really you invest $1 billion is to buy a huge portfolio of someone else's business, or you really get into the downtown markets, where you really get into mass construction. And what we're taking we want to take a more refined approach. We recommend that each of the family offices do the same thing. And you have a number of assets, like I said, that if you have to hold them, if all of a sudden we go into another pandemic and you have to hold them for 5 or 10 years, that they're strong assets. Once you get in the position of trying to deploy $1 billion, you have to buy and turn and churn really quickly. And we think that we all know the next 5 years has some uncertainty coming. We don't know when it's coming, but we know it's coming at some point. So we're a big believer in investing in those key assets.
Great, thank you. Two questions came in somewhat similar. On the East Coast, besides Charleston, what other cities do you focus on? And then the next question would be, again, where is the balance for geographical, current horizon projects?
Sure. We just focus where we have our connections. So we have great connections in Charleston. We don't focus specifically in those areas. So for example, if you are passionate about Hilton Head or New Smyrna or one of those places, Nags Head, we'd probably recommend you go with another developer and not go with us. But we think what we define as live, work, play is any place where someone that had a successful exit from their company, 100 million or more, where they kind of want to live, where they can have fine restaurants, they can have casual restaurants, they can have beach or mountain, they can have hikes, they can play golf or tennis. We think these are really kind of the areas that are going to boom over the next really 10 to 50 years as people get away from, nothing against some of our lovely Midwestern cities, which I've lived in some of them. But people with money are going to want to be where they can be outside more and they can play more, but they still want high internet, great legal teams, great accountants in their towns. They still want to be in buzzy towns, we kind of use. They don't want to be in the middle of nowhere. So really just go up and down the coast and up and down the mountains. And these are some of the areas that we think are great investment opportunities right now.
Perfect, thank you. Frank wants to know if you can talk a little bit more about the fund, maybe the size, number of properties desired, the term. I know you already went over the minimum investment, but if you can kind of elaborate.
Sure, we have a fund deck that spells all that out, that dots all the I's and crosses the T's, that I'm happy to send out to you. But long story short, we're in this initial raise of 100 million. We're gonna have 10 to 15 properties at different phases from land to build out within that deck. And again, we're looking at 250,000 minimums. Most of our investors are coming in around the $3 to $5 million range. But I'm happy to more dive into the details. One thing that's really important to us is the partnership and the synergy. Again, we're not raising money on the internet or just raising money from anyone. We want select partners that kind of have similar DNAs and similar goals. So we'd love to chat and talk more about that, but I can send along all those details anytime.
Great, Scott, thanks. Vikram has a question. What is the minimum holding period for your fund for investors?
We have a suggested 3-year minimum hold. Again, depending on the size of the investment, if someone wants to invest 250,000, we have more flexibility than if they want to invest 50 million, for example. But we think a relatively 3 years, and then we have a notification period of 6 months to exit. So we're hoping that not everyone wants to. Again, that's where our blend, if we have 10 or 20 of the right partners, we have some mix in there. We do not want to be, and we aren't in favor of some of the traditional REITs where they have a guaranteed lockup and a required sale period, because what we've seen, again, another one of my friends down here that works for $1 billion REIT constantly bemoans that we have these fantastic properties that we have to sell because it's part of our lockup and part of our change. And so we want to be flexible in that. What our fund's philosophy is 1/3 of our properties will be short-term flips from a plan, 1/3 will be long-term holds, and the other third will be in the middle, kind of opportunistic based on market cycles, and might go short-term or long-term based on what's happening in the market.
Perfect, thank you. And Scott, can you tell us how the Swell Fund became an integrated real estate company?
Yeah, it became over time. I mean, my partner and I, Eric, started Swell Property back in the early 2000s as a real estate brokerage, quickly got into development, and it's kind of a funny story. It happens most of the time in life. we decided to open up a part of our office to get more rent during the down cycle. And our architect, Lindsey Brown, wanted to work next to us, and the handwriting's been on the wall ever since. We're all now neighbors, and we work together, we share offices. And I think the integration comes from working with people you like. We work mostly with, in the past, I mean, we work with ourselves now, but in the past, we always like working with boutique developers or architects or builders like us. You get more personal attention. It's easier to pivot than when you're working with the large firms. Again, nothing against those firms. And certainly if I was building an 80-story high rise in downtown New York, I would use one of those firms. But for what we're doing, we feel it's just a much better journey and a much better path to work with our partners. So it's really been since 2008, 2010 that we've been working together and just slowly evolving as a company.
Great, thank you. Let's see, moving on. Next question. Something just came through here. What was your focus pre-pandemic compared to your strategy focus post-pandemic?
Yeah, I think our strategy hasn't changed a lot. We kind of saw this happening ahead of time. I think, to use the overused analogy, we just really sharpened our pencil. We've been looking more at assets that need more significant development. In the past, we looked at things that maybe just needed a tweak. Those we think are getting priced out of the market right now. We're looking at different opportunities where our expertise in development and design and architecture can really bring new value. Entitling opportunities, we're looking at a little bit harder now. We just closed on a $10.5 million piece of land a couple days ago, or started escrow, excuse me, on that. We think land's a really unique opportunity. But we've also, what I'd say more than anything else, what's happened post-pandemic is people have started coming to us. Some people with some pretty unique properties have come to us and say, we want to either sell our land to you, or we want to do a kind of modified JV with you. It's our family's land. We have pride in this. We want it to be something cool. We want it to be something that stands the test of time. We want it to be a legacy. Just the other day in Tahoe, someone came to our group with an amazing opportunity because they're seeking us out, and they don't want to go to the major home builders that are just going to cram as many houses on there as possible. Or another one's a hotel. They were going to go with more of a traditional hotel, and now they're looking at going with a boutique option and want us to evolve. So I think that's the major change, is people are wanting more design and more thought and more pride in their ownership. They want to be in Dwell magazine, and that's really what we've seen changing our firm more than anything else.
Great. And next question is coming from Frank. Have you had any funds previously, or just taken investments for specific properties?
Yes, we have specifically not had a fund previously. We have dozens and dozens of LLCs that have been on specific properties. I've worked in foundation and tangentially on some things, but this Swell Fund is Swell Businesses Group first fund.
Perfect. Thanks for clarifying, Scott. Next question. Can you tell us a little bit about your last sale or closing and what made that property unique?
Sure. We closed last week. We closed on a $3.7 million piece of land, and Monday we're gonna close on a $4.9 million house. And they're both the same thing. They're half acre or more, and they have amazing ocean views on really cool streets. And on the land, it's coming with plans that we designed, so the design's in there, and on the house, we designed the house. And so when people are moving and they're looking at what's available in the market, and mostly what's available in the market is not what they want, or it's high-priced assets that they're like, oh, this looks like it was designed by my parents' architect, for lack of a better word. When they're finding what we do with land and ability to have a pool and ability to ADU, kind of those things I went through on that one slide, people are paying whatever they want for it. And in the one situation, it's even a little, we're even pricing it a little over market, but they have enough money that a little over market, it doesn't dissuade them. They've identified they want to live here for certain reasons, and they want to live in a baller house, and we can offer that to them here.
Fantastic, thank you. Let's see, next question. Since you're based in California, do you have a heavy West Coast presence, or would you start a project in the Hamptons or Cape Cod? I think we did kind of talk about the locations,
Yeah,
but
I'll just touch on this. I'll just touch on this again. You know, if someone on this call, like their family had something in the Hamptons or Cape Cod that they wanted us to help with, we'd help on a architectural type design standpoint. But we're not looking necessarily from the fund to invest in one piece of property in the Cape or one piece of property in the Hamptons or a small commercial office. You know, there's always possibilities for joint ventures at the right size. I estimate that people on this call could have 25 million in assets or 2.5 billion dollars in assets. So you never want to say never, but our focus again is primarily West Coast US.
fantastic, thank you. Now, Scott, that does seem to be all the questions as of now. There were a couple of people that were interested in getting a recording of this webinar and some more information. So yes, I will be getting all of that information to all of our attendees. Is there anything else that you would like to add? Actually, looks like Dennis has a question. Is there any current income feature for investors, even if it's periodic?
Yes, that is an option.
Perfect, thank you. Again, Scott, is there anything final that you'd like to say before we kind of wrap up today?
No, just it'd be great to connect with each of you, whether it be, you know, over email or over Zoom, and of course, and just see what potential interest there is, and whether there's interest in the Swell Fund or just helping, you know, kind of part of it is a long-term relationship, just kind of helping what you're looking at. We're here to be a resource for you, so it'd be great to connect.
Scott, great. And you know what? I'm so sorry. April Anderson actually has a great question that just came through. Would you be interested in development of a self-storage company?
Probably not, but we would, if it's in our area and we know that the area with some ancillary things. But again, what our focus is and what we want to preach from the mountaintops, if we can, is find people who are experts in those areas and work with them. We think, again, just using that as an example, it's a great example. So let me just talk about it for a minute. You know, if it's the family already has that piece of land and it's in a location where we've worked before and it's just helping kind of with the design and build of it, potentially that is something our firm might look at, and we would recommend you might look at other firms you partner with. But if it's like, hey, my family has said we want to get in the storage business, pick out the right location, pick out the right owner operator, pick out those things, I would never come to us. I would go to someone that knows those things. And we think the real estate market, as it's transitioning, what's most important is finding people that know their lane, that are experts in their lane. And we talk about the diversification of assets and diversification. We also said of partners. You find those people who you really trust and really know what they want. And if they're investing per se in that storage unit, they might say, hey, the next 2 years could be tough, but this is going to be a great performing asset in year 10 to 12 because we know these market factors. You know, we don't know that about self-storage, but there are people out there who know that.
Great, I think that was a perfect answer and kind of a great way to wrap up our presentation today. Scott, it was a pleasure having you. And again, to all of our attendees, I will be following up with everyone. If there's any additional questions, I would love to get you in direct contact. Have a great day and Happy New Year.
Thank you, everybody.